What is going on? Welcome to my channel, fellow income investors. I am the Covered Call Guy, and on this YouTube journey, my goal here is to create $120,000 in annual passive income using Covered Call ETFs, of course, subject to change. So let me know where I should pivot once I reach my goal, because of course, I want to protect my capital, and of course, I want some dividend growths, ETFs or stocks, CEFs, any other things. I'm open to all options. All right, my projected annual dividend / options income is $82,000 a year, 6.8K a month, 1.5K a week, $226 a day, $9.42 an hour. I will be updating this at the end of every month. For those who are new and asking, I will be updating this at the end of every month. Of course, showing my portfolio and what I'm holding, what I bought, what I've sold, or if I'm just holding cash. So at the end of every month, I will be updating this. Hopefully, of course, projected annual income didn't drop too much, or at least stayed the same, right? That's the best hope. So, legal disclaimer before we start this content. This content is for informational and educational purposes only and should never be considered financial, investment, or tax advice because I am not a licensed financial advisor, investment professional, or tax expert. All opinions expressed are my own and may be inaccurate or incomplete or just flat out wrong. So please always conduct your own due diligence and consult with a qualified licensed professional before making any financial or investment decisions. Remember, I am just some random idiot you found on YouTube, and of course, I could be completely wrong. Now, with today's topic, it's going to be more of a, I guess it's going to be a little sensitive. We're going to be talking about crypto, right? Crypto covered call ETFs, and of course, we're going to be asking, is it just high yield or high risk or both, right? So disclaimer, right? I have high conviction in crypto. However, my conviction ends the moment it is discovered who is behind Bitcoin for the crypto world. Because again, for crypto, I only do Bitcoin, right? We're going to be separating the observable yield from conditional frugality, right? We don't want it to be, is it actual good yield or is it just really conditional, fragile risk we're buying? Again, I'm doing this because, like I said, in all my other videos, we should be looking and auditing our portfolio, if not once a month, right? Every other month, you should be looking at your portfolio because us as income investors, we have to actively manage our own portfolio, right? While looking at the active management. So it's not set and forget. So we have to revisit this and look at, hey, does crypto still belong in our portfolio? For those who want crypto, of course, right? So for those who don't believe in crypto, obviously, you look at it from a different point of view, right? You look at your other ETF and stocks. For this part, it's just straight crypto. So let's look at the 2026 yield trap. Are you getting played, right? That's the question is, are you getting played? My verdict, yes. Right? If you think 100% distribution rates are yield, you are being played. In a flat market, you are simply getting your own money back minus fees, right? The yield is actually a liquidation of your principal. Basically, yield persistence depend on stable NAV condition. Well, who's playing you? All right, this might get a lot of heat, but I think round-hill YBTC, right, about 100% rock, high turnover, weekly resets, churn your capital. Rex shares, right, CEPI, 100% return on capital, pays out a shrinking base. Yield max, YBIT, right, 88 to 94% return on capital, synthetic structures, masking NAV erosion. So at least I'm going to give you three that I think is playing you. If you are invested in these, I think you're getting played. If you got any investment in these, let me know if I'm wrong. I could be wrong, but I think these three are playing you, right? That's the trap here, is high nominal yield, mask capital destruction. And let's look at the hidden time bomb in your portfolio, right? The detonated bomb of Defiance ETHI, right? Status is liquidated in January 2026. For those who are not new, I made a video on this. And for those who are new, take a look at the video. I made a video on this, like 2.5 weeks ago, right? The cause was leverage plus capped upside plus volatility, right? It literally went to zero, right? And let's look at the ticking time bombs that I think will be pretty much going to zero. YBIT and YBTC. Extremely dependent on weekly option rolls. If spreads widen, right, that's your liquidity gap, the NAV will continue to bleed out, right, viciously, right? And then MSTY, single stock proxy risk here, right? If MicroStrategies, Decoup, or faces regulatory action, the income engine halts and pretty much it takes down everything that is tied with Misty, right? So these funds also rely on Coinbase liquidity, right? If that dries up, your exit door wields shut. So that's another thing people don't talk about, right? Coinbase, right? The risk here is the yield is very observable, but the structure dependencies are conditional. All right, let's look at a scenario, okay? This is a scenario, what I think could happen if the super cycle breaks. Scenario A is volatility crush, right? This is the trigger. Bitcoin volatility structurally compresses to 40%, right? The impact of this is that option premiums collapses, right? Funds like BTCI and YBIT must double leverage just to maintain advertised yields, right? This is risking a blow up. And scenario B is deleveraging shock, right? The trigger is hawkish Fed or geopolitical shock, right? Like Greenland. The result is Bitcoin drops 20%, right? DVOL spikes. The math here is that you lose 20% of your principal to make 2% income. The math breaks. And when the math breaks, of course, the structure breaks, right? I always talk about the structure. Structure is very important, right? I don't think this is just a straight prediction, but a stress test of structural mechanics, right? Macro policies pretty much now drives price action more than protocol updates, right? Technical analysis is kind of worthless for almost everything, not just crypto. All right, so how does the government force you into risk? These are pretty new for those who are, into politics and kind of keep up with it. Remember the Genius Act, right? This was basically the ban, right? It prohibits stablecoin issuers from paying interest. It killed risk-free yield, right? So this is the consequences I think happen, right? It inadvertently forces institutional capital out on the risk curve to cover call ETFs like NEHI and YPTC, right? To find cash flow. And on top of that is the Clarity Act and ETFs 2.0, right? This is the consolidation. Vigorous disclosures create a winner takes most dynamic, right? Smaller firms vanish, right? Pretty much you're cycled into just a few, right? And there's the shift here, right? Institution now want outcome-oriented products, right? These are the ETFs 2.0, making flows stickier but sensitive to macro data. This is the law. Regulations pretty much destroyed safe yield, leaving only structured risk. Now, do you want that risk with the high yield? It really depends now. Is it really high yield, high reward type of investment here? Right. Let's look at the forensic audit of structural fact check. We're going to be doing ProShares, which is future based, right? The yield claim here is that it's real interest income. The structural reality, I'm going to say it's accurate but incomplete. Why? Yes, T-bills collateral generate real interest, about give or take 5%, maybe 4% now, right? However, the rest of the return comes from future rolled yields, right? This is beta exposure, not pure cover call premiums. And then let's look at another one with NEOs, right? It does section 1256. The yield claim is that they're claiming right now at least 96% return on capital. Structural reality, true, but it's just nuanced tax classification, right? The correction here, I would say, is its high return of capital is driven by Section 1256 tax rule, which is a 60-40 split, but not necessarily fraud like a lot of people would say. A lot of people claim, crypto, why even do it? Why even get into it, right? That's a whole different topic, but I'm just going to end there. Right? It does not automatically mean principal refunding unless NAV is structurally eroding independent of the trend, right? The real structural question here is, are these funds harvesting volatility or simply monetizing retail demand for yield? The answer depends on volatility, persistent, and option liquidity, not just accounting labels, right? Verdict here is rock is not always fake, but relying on it during a flat market is a risk to NAV durability. All right, the Wild West weekly paychecks and liquidations. Let's take a look at the other issuers, right? Global X, they're tickers of BCCC, BCCL, right? Strategy and Warning Signs is partial overriding, allows upside participation at a 1.2x leverage on BCCL. Roundhill, YPTC, and YETH, right? Weekly pay, systematic weekly resets, optimized for retail cash flow, extremely high gamma risk. Defiance, iBox, and MST, right? This is extremely aggressive, right? Credit spreads, pretty much. Their ETH one is liquidated on January 2026, right? Last month, proving leverage does kill. And then YMAX from YBit and MSTI. MSTY. Right, these are the proxies, extremely high volatility proxies of MSTR and Coin, right? Synthetic treasury structures, right? The warning here is that ETHI liquidation proves that complexity does not guarantee survival. So if you're holding any of these, you should be very worried, right? You have to worry about if they're actually making their money. All right, let's look at a case study of NEHI versus YETH, right? NEHI from NEOS, right? Their structure is active, monthly, and very data driven. The tax is about 98% return of capital with CFC losses, right? The verdict here is, I'm gonna say right now, it is built for holding. It does navigate volatility to preserve NAV. Versus YETH from Roundhill, the structure is systematic, weekly, and synthetic, right? The performance here is already negative 10.3% price year to date, February 2026, right? This month right here. Even with that, even with what's happening with crypto, looking at the structure, my verdict here is that it's built for churning, right? Is paying out a shrinking capital base. So the question here is really choose your poison. You want a tax efficient erosion or rapid capital depletion. It's a tough choice to make, but you don't have to take it. But if you're into crypto, it's kind of like, oh man, my hands are kind of tied right now, at least in this market condition, right? The comparison frequency matters for these two. Like weekly resets increases gamma risk significantly. All right, let's look at the liquidity tax. Simple and painful. And here's an example here, right? Always talk about the call spreads. For example, look at SPY options. Cost to trade literally 1 cent, right? Cheap, liquid, and easy versus IBIT options, 5 cents, right? Cost to trade. It's essentially 500% more expensive. So every time your ETF rolls a position, it pays this tax, right? It bleeds your yield dry. So this is kind of like your visual looking at it. I always talk about, hey, even if it was a cent or two higher, it matters because they're not playing a position, the amount we're playing. They're playing in the millions, right? Micro structure here, right? Inefficient execution is the silent killer of your gains. They have to make gains to pay you out. Otherwise, it comes from the NAV. All right, let's look at systematic risk, right? The one basket problem. What is the mechanism here? Your covered call ETFs like BTCI does not actually hold actual Bitcoin, right? It holds IBIT, which is iShares. IBIT holds 100% of its Bitcoin at one company, and that is Coinbase custody, right? We can look at the collapse scenario because it pretty much has happened, right? It's just a matter of will Coinbase collapse. Let's look at the breach. Coinbase suffered a hack outage or regulatory breach or freeze. Liquidity vanished, right? IBIT halts creation or redemption. Strategy fails. Your ETF cannot roll options. The yield stops instantly, right? You're basically now an unsecured creditor to one firm. And that's the fragility here. We've centralized a decentralized asset. This is a structural risk. That is pretty much against the whole philosophy of crypto. All right, the math doesn't lie, right? You are losing money if you're looking at, if you're holding any of this, right? NEHI or BTCI, right? YBTC, right? Rex, CEPI, basically total return, right, from anywhere from negative 15 to negative 18 year to date, right? This can lead to what we call the death spiral, which is volatility shock, premium shrinks, force rock distribution, your NAV decay, and the lower collateral based recovery, and it just keeps going back and forth. This is it. And it just, you end here and it goes back to volatility shock and then premium shrinks, and then pretty much the result is negative Sharpe ratio for the sector. Right. If you look at your performance here, the cushion was overwhelmed by delta losses, so it wasn't worth it. Right. High risk, right? Again, before I come to a conclusion here, It is high risk. All right, these are not passive income vehicles. They are capital destruction machines masked by high nominal yields. All right, high yields by design, high risk by structure. Of course, my final word here is do not use these as core holdings. If you're a crypto enthusiast as me, I like to spread my options here. I have actual Bitcoin, right? I have the BTCI, which I might, if you're new, I might not even hold that. I'm looking at it again on a 2026 reevaluation here, right? As you should reevaluate all of your position every month or every other month, right? We are not set and forget. Even on an index holding, right? I talk about other index ETFs. You still have to look at them and look at how they're performing because they are actively managed. So just be aware of what you're holding. I eventually want to mine Bitcoin myself, so I'm pretty much kind of just letting it be a growth potential on that side instead of an income potential. So those are my thoughts. I want to know how you guys feel about that, and if you're a crypto enthusiast like myself, how do you feel, right? Right? Don't get wrecked. Okay, I'm seeing a lot of people kind of very worried. Right? As long as you do your own due diligence and know what you're holding, right? Understand that institutions are selling you volatility while buying your spot. So know the difference. And of course, subscribe or have fun staying poor. Of course, that's a joke. Drop a comment which ETF is in your portfolio for crypto. I want to know. I still like crypto, but at the beginning, I did say that if we ever find out who's behind Bitcoin, I will be completely out. I don't know how you feel about that or you feel the same. So thanks for watching, guys. You're amazing. Stay tuned. Catch you guys in the next.